Okay, I think we can begin here, Andrea and Roy. I just wanted to thank everyone for joining us today, and I just have a quick introduction, and then I'm going to hand it off to Roy and Andrea, your resident experts on today's webinar. So allow me to please introduce myself. My name is Taylor Curran, and I'm the Senior Coordinator of Member Engagement here at the Toronto Board of Trade. I would like to thank you all for joining us this morning for our Value Member Workshop hosted by Retirement Compensation Funding. Today's topic is going to be focused on optimized retirement wealth, mastering passive income rules, and pension planning. Before we begin, I would like to acknowledge this land that we are meeting on, which is home to diverse First Nations, Inuit, and Métis people. Though you could be watching or joining us from anywhere, please note that the board's offices are located on the traditional territory of many Indigenous nations. They share with us a sense of responsibility for intergenerational equity, the well-being of today and tomorrow. If you do have questions throughout the webinar, please put them in the chat and we will be sure to address those at the end of the presentation. And without further ado, I would love to pass it over to Andrea and Roy.
Good morning. My name is Roy Craig. I'm the founder and executive partner of Retirement Compensation Funding. We have almost 100 people signed up for this webinar today. And for those that are getting in later, it is being recorded, and the board, you will have access to that through the Board of Trade. For over 35 years, our company has been working with public corporations and with to fund or secure their pension promises, and for private corporations to help them end pension inequity and set money aside for retirement. Two things stand out to us over this 35 years. Slide. What we've discovered that most private corporations have in common is that they do want to set aside some of their annual profits for people in the company that help earn them, family members. But the biggest problem they have is how to do this tax effectively. And they cannot do that by themselves. They need professionals to help them set this up properly. I'd like to introduce Andrea Lettner, who is our managing partner, and she will introduce us to the agenda for this morning's seminar. Andrea, over to you.
Hello, everyone. Thank you for joining us today and welcome. So let's talk about our agenda. Our next slide, is pension inequity. And we feel that pension inequity stands as a pressing issue that demands our attention and scrutiny. Today's realities paints a vivid picture of the pension landscape fraught with imbalances, prompting us to question the root causes and seek viable solutions. The lens through which we examine our topic today widens as we explore the impact of corporate taxes on pension structures. As well, we're going to look at the Canadian Income Tax Act and how it emerges as a focal point in our pursuit of equitable pension structures. And to ground our exploration today in practicality, a case study will illuminate real-world scenarios where pension inequity has tangible consequences. Moving forward encourages participants to get in touch with us. And in traversing these agenda points, we embark on a journey today to unravel the complexities of pension inequity. So here we have an example, the twins. To demonstrate the concept of pension inequity, we have the twins, Mr. Public Sector Executive and Mr. Private Sector Business Owner. In the realm of retirement security, the contrast between a public sector employee and a private sector business owner reveals a stark disparity, underscoring the financial challenges faced by individuals in different professional spheres. So here are twins in retirement. So let's examine the pensions of the twins. Mr. Public Sector Employee retires with a pension of $321,000. and Mr. Private Sector Business Owner with a pension of $104,000. It's obvious there is a considerable shortfall, $216,000 between the two, prompting a closer look at the factors contributing to this marked difference. In our example, Mr. Public Sector enjoys a robust pension of $321,000. This pension represents a financial safety net that reflects years of service within a structured system. On the other hand, Mr. Private Sector Business Owner's pension of $104,000 underscores the challenges faced by entrepreneurs and those in the private business realm. The significant shortfall of $216,000 between those two pensions demonstrates the broader pension inequities that exist today. I will now pass the presentation over to Roy to discuss today's realities.
Now, to understand what the tax realities are today, we have to go back. Let's go back to the year 2000. In 2000, the small business rate in Canada was $200,000. And what happened was that for every dollar of profits over $200,000, there was a higher rate of tax paid, but it was retroactive to the first dollar. So what was happening in the year 2000 was that many business owners were being forced to pay themselves bonuses that they did not otherwise want to take and pay personal tax on it. And it was the year 2000 that what we're talking about today became part of the landscape for small private corporations in a strategic alliance we had with Canada Life. And we were able to help small businesses, hundreds of them across the countries, with their problem. Now, fast forward to today, the small business rate is $500,000. And if you have a dollar of profit over the $500,000, you pay the higher rate of tax, but it is not retroactive to the first dollar. So what this has done, it has opened up small business to make it much easier to expand the business and to build the business. And on paper, it looks like it's much easier for an owner to set aside money for themselves. But what appears on paper is not necessarily what happens at the end. Slide. Now let's look at this a little bit closer when it comes to setting money aside for retirement. Private business owners, they really have the same options as an employee would have. Whether it's a money purchase pension plan, which is the company equivalent of an RSP, or if they set up an individual defined benefit pension plan. But all these plans have contribution caps or benefit caps. And for many small businesses, you know, having to sell part of the operating company at some point in time to have for funds for retirement is not an option. Now let's look at the small business tax. The pro of it is that the small business tax on the first $500,000 of income is only 12.5%. So an owner could easily think, well, that's not bad because I can make up to $500,000, pay 12.5% tax, and set some of this money aside for myself down the road. But the government really doesn't want you to do that. And they show that initially, the first con is the investment income tax, because the CCPC, they pay investment income tax of 50.17% versus 26.5% in a non-CCPC. So basically what the government is saying to you is, okay, fine, we'll let you pay 12.5% on the first $500,000 of earnings, but if you're going to if you're not going to reinvest that money back into the business and try to set some aside for yourself, we're going to ding you with a higher investment income tax. Now, added to that are the new rules that came in 2019 called the passive investment tax rules. Next slide. Now let's look at these new rules briefly. They're based on what's referred to as your adjusted aggregate investment income. And you can see with what the Minister of Finance said in 2017, which underlined what I just said to you before about the higher investment tax rate. The government does not want you to be setting aside any of the profits up to the first $500,000 for yourself. They want those profits invested back into the company. And their remedy for the passive investment income was that for every dollar that your passive investment income exceeded $50,000, they're going to grind down the small business rate by $5. Now, I can tell you this is punitive, and we will show you that a little bit more. Now, next slide. In addition to the passive investment rules, those of us in the pension business and many investment advisors who happen to be on the seminar, there's two other things that we worry about. We worry about the investment tax rates and the mitigation of them. And also we worry about the 21-year tax rule for family trusts because many wealthy private corporations, the operating company is owned by a family holding company, and the family holding company as well is owned by a family trust. So let's look at these three taxes a little bit more closely as they impact retirement saving. Now, the passive investment rules, this is a complicated tax. It's a moving point in time. And at its worst, depending upon the province that you reside in, the tax reality is you could end up paying $1.20 in tax for every dollar of investment income over $50,000, which, as I said before, is punitive. Now, what happens with this passive investment tax, it's a moving point in time, and every company is going to have their crossover point. So what is happening now is the accounting firms and investment advisors are having to help their clients mitigate this tax. There are ways that it can be done, but the eye has to be kept on the ball because otherwise what happens is a company ends up having investment earnings over the $50,000 that they were not expecting. Next slide. Now, the price of the small business tax deduction, as I indicated to you before, was a 50.17% investment income tax versus 26.1%. Now, investment advisors will find ways, and there are ways that you can try to avoid this tax by using tax deferral, and that could be corporate class mutual funds, the use of corporate-owned life insurance, deferred, some investments where the money that is paid out is deferred. But somewhere down the road, it's going to catch up when money comes out. And you can appreciate from our perspective and anybody in looking at building up portfolio wealth, that the difference in the tax of 26 versus 50% is quite significant. Now, one of the other concerns that is creeping in there now is that some of the more sophisticated estate planners and accountants have tried to help their clients get around this 50.17% investment income tax by setting up other arrangements, investment holding companies, that basically the money that's been set aside for long term can be taxed at a lower rate. But in the past couple of budgets, CRA is implementing provisions that will allow them to deem some of these arrangements as CCPCs. So that's one of the concerns that has to be looked at. Next slide. Now, this is one of the hidden taxes that a lot of people forget. It's on my mind because I started off my career at Royal Trust and was in the trust department. But family trusts are deemed to have disposed of their assets every 21 years. Now, when you think about this a little bit, the money that we want to set aside for ourselves and for our family, that money is going to be used over quite a long period of time. I mean, an owner who's 50 years of age right now could live to 90. So the money that is being set aside could be used over a period of 40 years. If you add children into it, it could be over a period of 60 years. So what can happen is that the exposure on the pool of assets that is held in a holding company impacts the value of the family trust. And so what can happen down the road is money that you might otherwise have wanted to set aside to pay other people ends up having to go up to the family trust to pay the 21-year tax. Next slide. So what does this all mean? Well, there's lots of potential tax liability. Now, I underline the word potential because we have a lot of smart accountants and smart investment people who are going to try to help you mitigate these liabilities. But they have to keep their eye on the ball. Now, you cannot blame a business owner for thinking that the government is out to get you. But it's not quite as bad as that, because there is a provision in the Income Tax Act that can basically wipe these three taxes right off the table for part of your profits. And I'm going to turn it over to Andrea now to tell you what that is. Andrea?
Thank you, Roy. Who doesn't love to talk about the Income Tax Act? Well, the good news is there is a meaningful solution to part of the pension inequity problem in the Canadian Income Tax Act. Within the Income Tax Act, we have found a solution, and it's called a retirement compensation arrangement. It has been in the Income Tax Act since 1986, and it was RCF working with a major accounting firm that established the first RCA in Canada for a public corporation. An interesting statistic, over 90% of public corporations with defined benefit plans now use RCAs to either secure or fund pension shortfalls. Private corporations can also use RCAs to address the pension inequity we see with the twins. The RCF products focus primarily on family group supplemental pension plans utilizing RCAs. Under Section 2248.1, of the Income Tax Act, the term RCA refers to a retirement compensation arrangement. An RCA is a specialized form of arrangement established by employers to provide retirement benefits to employees. Unlike traditional pension plans, RCAs are subject to unique tax rules, as outlined in the Canadian Income Tax Act. Some of the key features are employer establishment, I just talked about. They're established and maintained by employers to fund retirement benefits for their employees, i.e. family members. Funding and contributions. Employers contribute the funds to the RCA on behalf of the employees. Unlike other pension products, there are no caps if the entitlement guidelines are followed. These contributions are based on a predetermined formula and are intended to fund retirement benefits. Let's talk about how an RCA works. Contributions, money, is divided into two accounts and split 50-50. The RCAIA is held by a corporate trustee. The RTA account is held in a special division of the CRA. All the money comes back to the plan members in the form of benefit payments. So here we have a graphic with three circles. We call that contributions and hitting the sweet spot in the middle. Some of the benefits of an RCA include no limitations on final T4 average earnings, no constraints on corporate tax deduction if entitlement calculations are followed, and unlimited potential for retirement income. Additional advantages. Well, the trust is creditor protected no matter what happens down the road. The RCA trust is also exempt from the 21-year vesting rules that typically apply to trusts. RCAs are also exempt from the rules regarding the safe income test for inter-corporate transfers. RCA contributions for past service can be financed, potentially leading to a reduction in retained earnings, and any unused contributions can be carried forward. RCAs diminish passive investment income for corporations, alleviating the impact of the decrease in the small business limit from $500,000 and potentially mitigating concerns about incurring a higher general tax rate. Roy, would you please take us through the case study?
Thank you, Andrea. Now, this case study is based upon an actual family group RCA that we have in the office. And the full case study is available for those that would like it. It includes all of the entitlement calculations and the funding calculations and the RCA ledgers. What I've done today is just take out a few of the slides to basically show the significance of what this does for family corporations. Now, in this case here, we have a dad and two children that are in the business. Now, what's important to understand is that these family members, and they're working in the company, but they do not own any shares of the company. And this is important for people to get their minds around, because the shares of the operating company are owned by a family holding company. And the family holding company is in turn owned by a family trust. Now, you can see here that the base salaries of of dad and the son and the daughter are basically just sufficient to cover whatever they need to run their life on a day-to-day basis. Any additional share of the profits that they might be entitled to, the only way that those profits can come out to these individuals would be by a taxable bonus. But we know what happens to taxable bonuses. They are subject to the top marginal tax rates for that individual. So what we have set up for this family here becomes particularly significant. Now, dad is 60 and he likes working, and he is going to extend his retirement to 70. He wants to give the children another 5 years of getting some expertise before they take over for him. The two children, they've indicated they want to retire at 60 because they hope to have their children in the business, and they want to be able to pass the torch a little bit sooner. Now, understand that if we had not set this up, the benefits I'm about to show you that go to the dad and the son and the daughter would not go to them. What would happen is the corporation would pay the tax, and the money would then go by dividend up to the holding company. Now, in the holding company, dad's only entitlement is equal to the preferred shares that he would have taken back when the estate freeze was done. And the value of those preferred shares is probably lower than what they're really worth, because the accountants would try to get CRA to accept the low valuation. The children, the only way that they would access any of this money is if it goes from the holding company to the family trust. But guess what? There is one child that's not in the business, and these two children aren't the only beneficiaries of the family trust. So let me show you now the significance of this to the son, the founder, the son, and the daughter. Let's look at dad first. Now, his normal life expectancy is to 84. So you can see here what we've done with his RSP. We've just, as an offset, we've just assumed that the RSP is more or less paid out in an annuity format and spread out over the years. There's other ways that you can take RSPs. But this is just to show what it would be over a long period of time. Now look what the RCA is providing. This is 194,000, starting at 194,000. So from the day he retires at age 70 to his normal life expectancy, he's going to pick up $3.3 million that he would not otherwise pick up. Now, Dad could live longer. Next slide. Today, once you're over 60, longevity benefits start kicking in. And we have clients right now, RCAs that we set up many, many years ago, that are now still alive over the original life expectancy that we projected. So if Dad lives to 90, for example, there's another 1.3 million. Now, Dad also has a spouse. So what happens is Dad lives to 90, his spouse could live to 94. And so there's an extra $1.6 million there. So what does this add up to? The RCA can pay Dad an extra $6.3 million. And this is money that he would otherwise not get. He's got two choices. Either it's paid to him by way of a bonus, so he pays high personal tax, or he sets up the RCA. Otherwise, if the money goes into the holding company, all he's going to get out of it is preferred share redemption. Now let's look at the son. Now the son, over his life expectancy, can pick up $6 million. Now think about this for the son. He's working hard in the business. The last thing in the world he wants to do is to get a bonus today that he has to pay tax at 50% on, or a high marginal rate. But if this is not done for him, this money, he might never see it, because what would happen is that the underlying value would go to the holding company. And initially that money is going to go to redeem his dad's preferred shares. And then what's left over is going to go up to the family trust. Now the son also has a spouse. So between the son and the spouse and longevity benefits, all of a sudden there's $9.5 million of benefits that can go into the son's hands. Now let's look at the daughter. The daughter, I mean, she's married, but we can't illustrate survivor benefits for her husband. They're there. And the reason why we can't illustrate them is because women live longer than men. But the total amount of cash that's there for the daughter is $10 million. So what does add this up in total? So between the three of them, and the third generation benefit. And let me tell you about the third generation benefit. In this particular founder group RCA, the dad had a concern. He was concerned because his children were young. He was concerned as to what would happen if the children died prior to normal retirement. And so what we did in this RCA is that there's a provision that if a child dies before normal retirement, they are deemed to have retired. But the problem for the RCA is funding that. So with the son and daughter, their funding was with one of the insurance companies. And as part of that funding, if the child died prior to normal retirement, the insurance company would kick back in money to cover the survivor benefits. In this case, that we've had them all living to a long time, so the money is still coming back in, and that can be used for the third generation that will be coming along after the children. So in total, what we've done is that we've managed to basically carve out $33 million of benefits to these working family members that are generating the profits. And they are going to be paid directly to them and to their spouses and to the third generation. And they are bypassing the holding company, and they are bypassing the family trust. Now, what does this cost? Now, here's where it gets rather interesting. Let's look at the individual funding for each of the three members. We can see that for Dad, until his retirement, it's $387,000 a year. And for the son, it's $215,000, and for the daughter, $213,000. Now, in actual fact, in this company, this represents actually not a bad distribution of the profits that they are making if they were going to be distributing them to the family. But you can understand that the last thing in the world that the family wants is to get, the dad doesn't want a bonus of $387,000 because that could, he'd have to pay a high marginal tax rate on that. So what we've been able to do here is we've been able to set aside a fair amount of money. Now, just one cautionary tale here. A company cannot just decide, oh, we have $1 million worth of profits this year, and we want to allocate them among family members. Let's just put them into an RCA so they don't have to pay the personal tax on it. CRA can come back and deem that an RCA is a salary deferral arrangement. So what happens is that you have to set it up as a retirement compensation arrangement, and you have to follow the funding guidelines. Because an RCA cannot take all of a company's profits. It can only take the portion of the company's profits that relate to the individual entitlements under the CRA formulas. So in this situation here, what we've been able to do is the company can divert $14 million of profits into the RCA. The net cost to the company is $10 million. Now let's look at the tax savings on this. Now, this is an approximate presentation because what we do is for every case that we put together, we provide the accountant a schedule that says, okay, if this money didn't go into the RCA and went in, they paid the tax on it and it went in the holding company, what would it look like down the road as to the taxes that would impact that? Now, this assumes that the money that goes in is all free and clear. There could be other tax losses and carry forwards that we're not aware of, but it acts as a guideline. And what we find is that the tax savings run from 50% to, in this case here, 73%. Now, the reason why this one is so high is that they're saving corporate tax of $3.8 million. They're saving investment income tax of $2.1 million. They're receiving the grind down tax of the passive investment of $325. But this company here, because of the fact that they don't have any big liabilities in the holding company, that their exposure to 21-year tax is quite substantial. There's another $4.3 million. So there's a lot of tax that can be saved. Over to you, Andrea.
Hi, so I'm going to talk to you about a corporate trustee. Just give you a brief explanation of what they are and how they function. So a corporate trustee is a financial institution, and they're appointed to oversee and manage trust assets on behalf of businesses to fulfill fiduciary responsibilities, ensuring the proper administration and execution of a trust according to its terms and relevant legal requirements. So how do clients benefit from a corporate trustee? Well, safety. All RCA investment accounts are held in the name of the trustee for the benefit of the plan members as per the plan document. Arm's length. The CRA knows the generally accepted guidelines are followed with no overfunding. Continuity. A corporate trustee cannot die or become disabled. They are there for the entirety of the RCA, which can go on for decades. Experience. Family or corporate circumstances can change. A corporate trustee has the relationship with both the CRA and the RCA provider, retirement compensation funding, to provide solutions. Administration. The corporate trustee has the systems to ensure that monthly payments reach the plan member, provide indexing as per the plan document, and ensure that all required tax filings are complete. Last but not least, relationship. Over time, the trustee builds family knowledge to assist through family life events. RCA benefits to a family. Well, assets are exempt from the estate and not subject to probate tax. Rewards the next generation of working families for their contribution to corporate growth. Can also include key non-family member employees. Spousal benefits can be directly paid from the trust without affecting the estate. Leaves the remaining funding for succeeding generation of working family members. And if pension plus funding is utilized, it offers longevity benefits at no extra funding cost. What are the business benefits? Well, RCAs offer an exemption from the safe income test rules for inter-corporate transfers to a holding company. They provide flexible funding options for past service, allowing the carry forward of unmade contributions. Funds held in an RCA are creditor protected, and the strategic funding allocation prioritizes the benefit of the next generation of working family members. What are the tax benefits? Well, you get to channel pre-tax corporate earnings into a creditor-protected pension, exempt from the 21-year vesting rule, and decreases the assessed 21-year tax for companies owned by family trusts. RCAs are ideal for those qualifying for the small business tax rate and helps to diminish the corporate passive investment income for eligible firms. RCAs alleviate the risk of reduction in the small business limit from $500,000. An RCA supplemental pension also has the potential to generate significant tax savings for companies subject to the general rate of 26%. They also provide a safeguard against future potential corporate tax increases or modifications. Corporate contributed funds are tax deductible, and contributions remain tax deductible for plan members until benefits are accessed in retirement. So here's our key points. In summary, RCS supplemental pension projects. They are the solution addressing the prevalent issue of pension inequity between public and private sectors. RCF offers innovative products that stand out and potentially eliminate caps on both corporate contributions and plan member benefits. One of the key advantages of the RCF supplemental pension products is their unique approach to corporate contributions and plan member benefits. Unlike traditional pension plans, our solutions don't impose any caps, again, as long as entitlement calculations are followed, ensuring that both corporations and plan members can maximize their financial benefits without constraints. Furthermore, RCF supplemental pension products aren't just a pension plan. Our products are strategic financial tools for businesses. By leveraging our innovative solutions, corporations can unlock substantial tax savings. The potential for significant corporate tax benefits adds a layer of financial efficiency, making the RCF supplemental pension products a smart choice for businesses aiming to optimize their financial resources. In summary, the RCF supplemental pension products are a game changer in the pension landscape, addressing inequity concerns and providing unmatched flexibility. It's a powerful financial tool that aligns with the dynamic needs of modern businesses. Please don't hesitate to reach out to us if you need more details. Thank you very much for participating in today's webinar, and we look forward to contacting you in the future.
One last comment. Appreciate those of you who have attended the seminar today. We have hundreds of RCAs established. In fact, the first RCA we established back in 1988 is still in pay. So we do know that what we offer can be of tremendous advantage to many companies. We work closely with your accountants and with your lawyers and with your financial advisors. And we look forward to helping anybody that requires help. I'm turning it over now back to Taylor. There might be some questions that have come in, or anybody that has a question can ask it now. Thank you very much.
Awesome. Well, thank you, Roy and Andrea. It was an amazing presentation. Just a couple of housekeeping items before we get to the questions. This session is recorded, and you will have access to the slides. Roy and Andrea will take care of sending that out to those of you that are interested in having those. She has your contact information, Andrea does, so she'll take care of doing that. And this session will be uploaded on the Board of Trade's YouTube website, so I will be sure to share that link with Andrea to share with all of you as well if you're interested in watching it again. We did have a couple of questions that came through the chat. So to either Andrea or Roy, the first question that came in is, what happens if a family leaves the company?
Do you want to address that, Andrea?
Or
do you want me to address it?
Yeah, you go ahead.
What was the question again, Taylor?
What happens if a family member leaves the company?
Well, that's a good question. And we have had that happen many times. When family members decide they don't want to continue working in the company anymore. What normally happens is that the funding that's in there for that family member, what it will do is that we recalculate. An RCA should be updated every 3 years. In other words, the entitlement calculations and the funding calculations. And so what happens is that if there's money in the RCA that was allocated to a family member who's no longer there, that gets reallocated to other family members. And what it does is it reduces the contributions going forward to support the family members that are still in the business.
Great, thank you. We did have another one come through the chat. Can an RCA be established if the founder is over the age of 71?
What was that one again, Taylor?
Can an RCA be established if the founder is over the age of 71?
Yes, it can. As long as you're, I'm a good example of that. As long as you're working in the company, an RCA can be established for you. And we have actually quite a few RCAs that we established where the owners are over 71. And one of the significant things about this is that we have companies that all of a sudden the time has come to pass the wand, so to speak. Some companies have children they can pass the wand to, but other companies they don't. So that the wand has to be passed to maybe employees. Now, the real advantage of the RCA is that dad could be, say, 75 years of age. He's had 35 years of service with the company. He's entitled to a 70% pension based upon his average, say, last 3 or 5 years earnings up to 75. What he has not lost is all his past service. So that what can happen for these older people is the company can set up an RCA for dad at age 75. If the company has enough funds, they can lump sum fund it because all his past service is earned. If they do lump sum fund it, as Andrea mentioned before, that might carve out part of the retained earnings. It might require the company to borrow some money from the bank. But what's going to happen is that dad is going to get his funded pension, and then the wand can be transferred to whoever is going to take over the company on terms that are acceptable to them. And if there is bank borrowings or retained earnings used, they get replaced over time with future earnings. So the RCA becomes a very viable tool for succession planning for older people.
Awesome. Thank you, Roy. Sorry, one more question here. What happens if the business cannot allocate funds to the RCA for a few months or even a year?
Andrea, why don't you handle that?
So if a company has to pause their RCA contributions, they are able to do that. They can make those up in future years, or they can borrow in future years to meet those funding requirements down the road.
Well, that's all the questions we have in the chat here.
Thank you, Taylor.
I'd just like to thank all of you that attended and joined us today. So thank you on behalf of RCF and the Toronto Board of Trade for attending today's webinar. Roy and Andrea, thank you both for your presentation. It was amazing. Do you have any final words for our attendees today?
Thank you very much for everyone who attended. Please feel free to contact us if you have any questions. We'd be glad to hear from you.
And for those that that registered but didn't attend, hopefully you'll be able to pick up the seminar through the Board of Trade's website. Thank you.
Thanks, everybody. Have a great day.